If you've been staring at charts for hours, second-guessing your setups, and still walking away with losses, you're not alone. The fact that you're a part of a massive majority of traders who are stuck in a cycle of frustration. The reality is that 80% of retail traders lose money. And it's not just speculation, it's documented by financial regulators. Some brokers in Europe disclose the fact that 90% of their clients lose money when trading CFDs. And these aren't just beginners, these are people who have been trading for months, even years. And another thing, retail trading lasts about 4 months on average before account is either abandoned or blown up, which means most traders don't even make it through the full market cycle before quitting. And if that many people are failing, is it really the individual? Is it the discipline? Or is the entire system flawed? Manual trading for most people becomes a psychological battlefield. You're constantly reacting to price movements, switching between strategies, chasing trades, and trying to find entries with zero consistency. You start a day with a plan, but as the market moves against you, emotions take over, you revenge trade, you have FOMO, you have confirmation bias, and it becomes a cycle. It doesn't matter how many indicators or trading books you consume, the results don't change. Meanwhile, what are the institutions doing? They're not sitting in front of charts all day, drawing Fibonacci levels or waiting for an RSI to go oversold. They're using algorithms. JP Morgan even reported that 80% of equity market volume in the US is now algorithmic. Other studies show that it's even higher than that, closer to 85%. And the FX market, it's estimated around about 70% of all volume is algorithmic. Futures, options, similar or higher. So, in other words, most of the market you're trading against isn't human. It's machines, it's models, it's data-driven, it's systems that operate without fear, fatigue, or second-guessing. That doesn't mean that you have to become a programmer or a data scientist or become part of a multi-billion-dollar research and development program for a hedge fund. There are now tools that allow you to enter into the algorithmic space without having to have any coding background. And today's video, I'll show you one of those tools and how to become part of the data-driven revolution. So what I'm going to do right now is give you a quick run through of how I build data-driven strategies. The first thing that we do is we have to define what we're going to build. So for this particular strategy, I'm going to build a long strategy on the NASDAQ, one of my favorite instruments to trade. I'm testing data back from 2018 all the way to present day on the 1 hour time chart. And the trading options that I'm testing is this is going to be a day trading strategy. So I want positions to open from 7 in the morning till 5 and no later than that. Therefore, on the lower volume time periods, no positions will be open. Now, the building blocks are essentially the instructions for what we're going to trade. Now for this particular test, I'm going to test a variety of different entry signals, lots of different entry signals from volume to ADX, whether it's rising, whether it's falling, average true range, etc. So there are lots of predefined conditions that we set. And I'm going to test lots of different orders, whether it's a stop order, whether it's an enter at market or a market execution order. And I'm also going to test different profit targets and whether it's trailing stop, or whether we're exiting after a certain amount of bars. So there's lots to digest there, right there, but we're giving the system free rein to data mine lots of potential strategies. For the money management for this particular test, we're simply going to do a percentage of the account balance and the filters that we're going to use. So we're only going to data mine strategies that have a certain amount of drawdown, a certain amount of annual return, and some other factors that are important to me, like the number of trades in the backtest. Obviously, the more, the better. And things like profit factor and return to drawdown. So that's an example of what you can do. And what the machine is going to do is, in hyperspeed, it's going to start data mining strategies based on the criteria. What this means is it's going to take one of the conditions of the entries. Let's say ADX is rising. It's going to look at that. Then it's going to test different parameters of that ADX. Then it's going to test whether you're using a fixed percentage, whether you're using ATR or fixed pip for an entry model. It's going to test all these different variations, way more than the human brain can comprehend, and it's going to do it on hyperpower and hyperspeed. And what you're seeing right now is some of the potential strategies starting to come through. It doesn't mean that we're going to use these strategies. It just means that we have found in the initial phases a potential strategy that's been data mined on the criteria that we've told the machine to mine. The next step is to start to stress test and actually pick the strategy. So let's get into that part. The first part of this skill set in this type of trading is prompt engineering. If you ask ChatGPT, for example, to write you an essay, you give it a prompt. Write me an essay on the history of the USA. That's the prompt. Then you get a output, which is the essay. The quality of that essay is determined by the prompt that you give it. The better the prompt, the better the essay. It's a similar type of skill set when we leverage data mining in our trading. We give the machine prompts to data mine strategies that are important to us with the entry model and risk, etc. Then the second part of the skill set is data analysis, is looking at the results and figuring out which strategies would be a good fit for you. So the test has now stopped and we can manually start to look at some of these strategies. I'm just going to make this a little bit bigger. There we go. So we can start to look at some of these strategies and analyze them. We have a simple screen of how the strategy performed over time. We have a list of trades that the strategy took. We have a equity chart of how it performed over time. So this is deep backtesting, as opposed to testing 50 assets or 50 trades. In the past, we test back all the way back to 2018 in this instance. It gives us a true representation of how effective the strategy is in different market conditions. Because guess what? The market back then is completely different to the market now. And logic would dictate that if it works in lots of different types of market conditions, then it's a sound, robust strategy. So then we can dive deep into the trade analysis. Like, what was the win rate? Was it on a certain weekday? For example, this strategy lost overall every Monday. So you may want to turn that off based on the stats. So every Monday you turn the strategy off. And then you can look at, was it a short-based strategy or a long-based strategy? And then we can go into the actual stress testing of the strategies. Now, one of the stress tests that we use is called Monte Carlo testing. And these squiggly lines right here, these represent 1,000 different simulations of basically me trying to break the strategy. In this particular instance, what we've done is we've taken the original strategy logic and we have randomly skipped trades. So let's say hypothetically that we took 100 trades. We removed trade 11, trade 15, trade 25, trade 74, etc. We randomly skipped trades. And does that have effect on the overall equity curve? Because if the strategy relies on one or two big wins to make it a good strategy, then it's not a good strategy. So we do 1,000 different simulations of that. And you can see all these squiggly lines is 1,000 of those simulations. And you can see all of them are profitable. One goes into slight drawdown, but all of them are profitable over time. And the thick blue line in the middle is our original strategy. That's one example of a Monte Carlo test. And there are lots that you can do to basically make sure that the strategy is robust. Now, you can't really do this sort of stuff when you're trading manually. You just don't have this data. Most of your backtesting revolves around you looking at a chart and seeing if it worked in the past. That's not deep enough to create a robust strategy, in my opinion. So that's just an example of how we leverage data to create robust strategies. I used to manually build strategies using chart patterns and discretionary logic, but here's what happened. When I compared one of my manual strategies to an algorithm generated by what I use now, the manual strategy looked good for a few charts, but over hundreds of trades, it was inconsistent. It had high drawdowns and it was emotional to manage. The algorithmic strategy, on the other hand, the ones that I build now, are statistically validated over years worth of data. They have smoother equity curves and I don't make any judgment calls. I remove me from the equation because I'm the limiting factor. And when you remove yourself from the emotional loop, you don't need to second guess your trades or spend all day staring at the screen. You let the data do the heavy lifting for you. The fact of the matter is most traders are stuck in a rut. They're constantly jumping from strategy to strategy, thinking the next indicator or technical confluence or layer of other factors is going to finally get them what they need. But the matter of the fact is, even if you follow a very, very simple strategy, every single time that you enter the market, your emotional state is different. You are slightly different as an operator. What that means is how you enter the market and how you manage the trade is slightly different every single time, which then means you don't really have an edge because every time that you enter the market is random. Whereas when you use automated systems to trade, every time that the logic presents itself for an opportunity to trade, there's zero emotion. It's black and white, it's binary. Therefore, you have true edge in the market. And because all of the strategies were created on years worth of data anyway, thousands of tests, you have real market edge. So if you're constantly in this loop of losing and inconsistency, consider stopping what the masses teach. Stop drawing squiggly lines on your charts and boxes because no one does that at an institutional level. Consider using a data-driven approach. If you want to know more about what we do, click the link in the description or somewhere around this video, and you'll be taken to a short 5-minute case study that shows you exactly how we trade the markets by leveraging data, by leveraging machine learning, and leveraging automation.